Have you ever asked yourself, does the US have a plan to avoid a big crisis? Well, let me tell you that the Federal Reserve can create dollars out of nothing, virtually printing money and injecting into the commercial banking system, much like an electronic deposit. By the end of the year, the Fed is projected to have purchased $3.5 trillion in government securities with these newly created dollars. One of many tools it's using to help prop up the ailing economy during the COVID-19 pandemic. Hi there, welcome to Investors Game. Today, we're gonna talk about why the Federal Reserve is printing money and how bad for the economy is this. And give us a thumbs up, that helps us a lot, so let's get started. Well, now that we know the Fed is printing money, also the Fed goal is to keep markets functioning after they have sized up in fear. The strategy also makes credit easier to obtain with a bigger money supply and lower interest rates. Without this and the Fed's other emergency measures, the economy will have crashed already. For example, the S&P 500 has reached a new high. Practically, this stock never would reach a new high during a crisis or a pandemic by itself. But in this case, the federal government bank isn't just creating massive amounts of dollars from scratch. The government also, in effect, using those newly created dollars to pay down its own debt, but at this time an unprecedented scale because of the economy's massive shutdown triggered by the pandemic. Alright, now how the Fed injects money into the economy. Well, the Federal Reserve doesn't literally print the paper dollar. That's the job of the US Treasury, which also collects taxes and issues debt at the direction of Congress. As a result, markets that had stopped working smoothly started to float again. Banks get more dollars in reserve and are more prone to lend money without worrying about exhausting their funds. Such big purchases of security by the Fed also effectively increase their money supply and drive down interest rates. This keeps borrowing costs cheap for those who need it. The stock market is one of the measures of how the economy is performing. If the consumer demand is high, revenue is high. The GDP will grow and so will the stock market. Now that we know the Fed is printing a lot of money, that of course brings a lot of problems for the US economy. For example, inflation. And if you don't know, inflation is the long-term rise in the prices of goods and services caused by the devaluation of currency. That means the government is printing money. While there are some advantages to inflation which I will discuss later, I want to first focus on some of negative aspects of inflation. Inflationary problems arise when we experience unexpected inflation which is not adequately matched by a rise in people's incomes. If incomes do not increase along with the prices of goods, everyone's purchasing power has been effectively reduced. So, what exactly causes inflation in the economy? There is a single agreed open answer, but there are a variety of theories. Number 1, the national debt. We all know that high national debt in the US is a bad thing, but do you know that it can actually drive inflation to higher levels over time? The reason for this is that as a country debt increases, the government has two options. They can either raise taxes or print more money to pay off the debt. A rise in taxes will cause a business to react by raising their prices to offset the increased corporate tax rate. Alternatively, should the government choose the latter option, printing more money will lead directly to an increase in the money supply, which will in turn lead to the devaluation of the currency and increased prices. Number 2, the money supply. Inflation is primarily caused by the increase in the money supply that outpaces economic growth. Ever since nations moved away from the gold standards during the past century, the value of the money is determined by the amount of currency that is in circulation and the public's perception of the value of that money. When the Federal Reserve decides to put money into the circulation at a rate higher than the economy's growth rate, the value of the money can fall because of the changing public perception of the value of the underlying currency. As a result, this devaluation will force prices to rise due to the fact that each unit of currency is now worthless. Number 3, cost push effect. Another factor in driving up prices of consumer goods and services is explained by an economic theory known as a cost push effect. Essentially, this theory states that when companies are faced with an input cost like raw goods and materials or wages, they will preserve their profitability by passing this increased cost of production onto the consumer in the form of higher prices. A simple example will be an increase in milk prices, which will undoubtedly drive up the price of a cappuccino at the local Starbucks, since each cup of coffee is now more expensive for Starbucks to make. Number 4. Exchange rates. Inflation can be made worse by our increasing exposure to foreign marketplaces. In America, we function on a basis of the value of the dollar. On a day-to-day basis, we as consumers may not care what the exchange rates between our foreign trade partners are, but in an increasingly global economy, exchange rates are one of the most important factors in determining our rate of inflation. When the exchange rate suffers, such as the US currency has become less valuable relative to foreign currencies. This makes foreign commodities and goods more expensive to American consumers, while simultaneously making US goods and services and exports cheaper to consumers overseas. Alright, now that we understand how inflation works, the stock market also can be overvalued or undervalued. But how we can measure if the economy is overvalued or undervalued? Well, the stock market capitalization to GDP ratio is a ratio used to determine whether an overall market is undervalued or overvalued compared to a historical average. The ratio can be used focused on specific markets, such as the US market, or it can be applied to the global market, depending on what values are used in the calculation. Okay, it is calculated by dividing the stock market cap by gross domestic product. The stock market capitalization to GDP ratio is also known as a Buffett indicator. So, if the inflation ratio falls between 50% and 70%, the market can be said to be modestly undervalued. Also, the market may be fair value if the ratio falls between 75 and 90%, and modestly overvalued if it falls within the average of 90 and 115%. The use of the stock market capitalization to GDP ratio increased in prominence after Warren Buffett said that it was probably the best single measure of where valuation stands at any given moment. To calculate the total value of the publicly traded stocks in the US, most analysts use the Wilshire 5000 Total Market Index, which is an index that represents the value of the stocks in the US markets. The quarterly GDP is used as a denominator in the ratio calculation. The market cap to the global GDP ratio can also be calculated instead of a ratio for a specific market. The World Bank releases data annually on the stock market capitalization to GDP for world, which was 92% at the end of 2019. Here's an example of how we can use this indicator. Let's calculate the latest market cap to the US GDP ratio. Alright, the total market value of the stock market as measured by Wilshire 5000 was $35 trillion, and the GDP for the second quarter was reported as $19.41 trillion. So if you remember, the formula is stock market capitalization divided GDP times 100. So the stock market cap is actually at $35.68 trillion, and the US GDP in the second quarter of the 2020 is reported at $19.41 trillion. The result of that is 183.82%. In this case, 183% of the GDP represents the overall stock market value and indicates it is overvalued. Remember what we said before, that the market is considered overvalued when it's over 90 or 115%. In 2000, according to the statistics of World Bank, the market cap to GDP ratio for the US was 153%. Again, a sign of overvalued market. This ratio may also have predictive value in cyclic peaks in the market. As of 2020, the ratio stands at roughly 150%. There are good reasons to believe that the stock market are currently in a justified state of euphoria and greed, which is mainly driven by the hype of investors who have so far been standing on the sidelines. No one can time the market, but it's to be feared that there's a lot of shaky money in the market right now. If this is a bubble, then could the upcoming potentially stock rally inflate this bubble even further? Well, the reality is that we need to see things from the Fed's perspective, and the Fed made it clearly that it will take a long time for a full recovery to take place, and millions of Americans who are out of jobs aren't likely to get their jobs back overnight. The recovery will take some time, which means the Fed will have to do everything possible to help the economy. We learned one thing from the previous crisis, which is that there is no point in fighting the Fed. If you like this video, don't forget to hit the like button. Let me know in the comment box, do you think the Federal Reserve will keep printing money? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.